In the ever-fluctuating world of finance, the Federal Reserve's stance on interest rates has become a focal point, triggering a chain reaction across various market sectors. Jerome Powell's decision to keep interest rates steady while hinting at 3 potential rate cuts in 2024 has unleashed a wave of optimism, propelling risk assets to unprecedented heights. As we delve into the market dynamics and speculative investments, it becomes evident that certain sectors, such as those intertwined with interest rates like Carvana, have experienced meteoric rises, with year-to-date gains reaching a staggering 1,000%. The allure of lower interest rates as a harbinger of economic prosperity has manifested in the stock market's buoyancy. The Nasdaq, a prominent indicator of tech-driven equities, has surged by over 50% year-to-date, signaling a robust investor sentiment. However, amid the jubilation, cautionary whispers emerge regarding the sustainability of this rally. Despite the Nasdaq's soaring performance, the broader S&P 500 has yet to surpass its previous highs, casting doubt on the depth and resilience of the current market conditions. A spotlight on inflation, a perennial economic metric, adds nuance to the narrative. Analysts project inflation to hover below the 2% target, a factor contributing to the prevailing optimism surrounding lower interest rates. Goldman Sachs injects an intriguing twist by suggesting that a swifter return to the 2% inflation target might expedite rate cuts, further fueling the ascent of risk assets. In the midst of this financial whirlwind, a corporate drama unfolds as DocuSign, a key player in the digital signature space, contemplates a potential sale. Speculations abound, with industry giants like Salesforce, Google, and Microsoft looming as potential suitors. The strategic implications of such a move for a company grappling with profitability issues are substantial, as a new owner could potentially revamp the expense structure, paving the way for higher margins. However, beneath the surface of these optimistic market trends lies an undercurrent of skepticism. A prominent figure in economic discourse, Larry Summers, underscores the inherent difficulty in predicting the economy's trajectory. He highlights the precarious balance between a soft or hard landing and the looming specter of economic overheating. This cautionary tone injects a dose of reality into the prevailing exuberance, prompting a re-evaluation of the narrative. The recent market rally, often attributed to a decline in long-term bond interest rates, raises eyebrows. Doubts emerge regarding the sustainability of this trend, with some suggesting that it might be a mere rebound from oversold conditions rather than a genuine indication of a new bullish trend. As investors navigate these uncertain waters, a call for prudence echoes through the financial corridors. In this landscape of economic uncertainty, an investment approach that emphasizes individual companies takes center stage. Larry Summers' counsel resonates as he advocates for a meticulous examination of companies, urging investors to scrutinize balance sheets, CASH positions, and resilience to economic stress. A cautious, company-specific strategy emerges as a prudent response to the unpredictable economic currents. As we dissect the multifaceted tapestry of the financial landscape, it becomes evident that the intersection of interest rates, market trends, and corporate maneuvers creates a tableau of complexity. Powell's carefully orchestrated dance with interest rates sets the stage, triggering a cascade of reactions. The stock market, a barometer of investor sentiment, responds with exuberance, pushing certain sectors to dizzying heights. Carvana's astronomical rise, tethered to interest rates and consumer financing, serves as a stark example of the speculative fervor gripping the markets. A nearly 1,000% surge year-to-date is a testament to the potent impact of interest rate dynamics on specific sectors. Lower interest rates, traditionally viewed as a positive economic signal, cast a favorable glow on risk assets, contributing to the Nasdaq's remarkable performance. Yet, amidst the celebrations, a sobering reality check emerges. The S&P 500, a broader and arguably more representative index, lags behind, failing to breach its previous highs. This disjunction prompts questions about the breadth and sustainability of the current market rally. Is the exuberance confined to specific sectors, or does it signify a robust and enduring economic resurgence? Inflation, a perennial concern, plays a pivotal role in shaping the narrative. Analysts' projections of inflation trending below the 2% target add a layer of optimism, reinforcing the allure of lower interest rates. Goldman Sachs injects a speculative element, suggesting that a quicker return to the 2% inflation target could catalyze faster rate cuts, providing an additional tailwind for risk assets. Amidst these market machinations, DocuSign's potential sale injects a dose of corporate intrigue. The digital signature pioneer, facing profitability challenges, contemplates a strategic shift. Speculations abound about potential suitors, with Salesforce, Google, and Microsoft hovering as formidable contenders. The prospect of a new owner reshaping the expense structure to bolster profitability adds complexity to the unfolding narrative. However, in the midst of this financial theater, Larry Summers emerges as a voice of reason, reminding us of the inherent difficulty in predicting economic trajectories. The dichotomy between a soft or hard landing and the specter of economic overheating introduces an element of uncertainty. Summers' cautionary note serves as a counterbalance to the prevailing optimism, urging investors to navigate with prudence. The recent rally, propelled in part by a decline in long-term bond interest rates, invites scrutiny. Is this a genuine shift in market sentiment, or merely a rebound from oversold conditions? Skepticism lingers, challenging the narrative of a new bullish trend. As investors grapple with these uncertainties, a call for a measured and company-specific approach gains resonance. Larry Summers' emphasis on scrutinizing individual companies becomes a guiding principle in navigating the current economic landscape. Amidst the macroeconomic ebbs and flows, a meticulous examination of balance sheets, cash positions, and resilience to economic stress emerges as a prudent strategy. In a world where uncertainty reigns, the focus on the fundamentals of individual companies becomes a compass for investors seeking stability amidst the turbulence. In conclusion, the confluence of Jerome Powell's interest rate decisions, market trends, corporate maneuvers, and economic uncertainties paints a nuanced picture of the current financial landscape. While the market celebrates the surge in risk assets and the promise of lower interest rates, cautionary voices, epitomized by Larry Summers, remind us of the intricate dance between optimism and uncertainty. As investors navigate these uncharted waters, a judicious and company-specific approach emerges as a beacon of stability in an ever-evolving financial landscape. Please consider liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.